Pramod Gubbi. He's Managing Director and Head of Institutional Equities at Ambit Capital, joins us right now on the show. Pramod, good having you. Thanks so much for joining in. Just wondering, what's been the feedback from investors across the world? You guys recently had this Singapore conference, if I'm not wrong, as well. What have you been telling clients with regards to the recent pullback that is seeing in EMs by and large in India too? And what's been the client feedback?
No, clients continue to be positive. In fact, foreigners have turned, incrementally positive in the last 3-4 weeks, given the sort of, stimulus measures we've seen from the government, which was sort of well needed to boost growth after seeing 5-6 quarters of slowing down in terms of GDP growth, and that had its own implications in terms of corporate profitability as well. So given where valuations were, it was badly needed in terms of a boost to the economy, and hopefully that will trickle down to earnings growth as well. Having said that, I think there are some geopolitical risks on the anvil, which can sort of flow into Indian fundamentals through the conduit of crude prices, just when the government is loosening its purse strings in terms of stimulating the economy. If you have crude prices running up, the ability of the government to boost economic growth by spending is naturally going to be curtailed. So that's something that people are watching out for. Other than that, it's very difficult to predict that risk panning out. The only hope is that, given how US shale oil has reacted in terms of supplies to every rise in crude, you can be hopeful that this crude rally is not going to be a runaway rally and will be curtailed at around these levels. But by and large, I think foreigners are incrementally positive running into it. They are watching some of the macroeconomic indicators very closely, particularly around fiscal deficit, current account deficit, and inflation. All three of these parameters have been fairly benign for India in the last 3 years, and all three seem to be sort of inching up in some ways. May not be so much the fiscal deficit. I guess people may not mind that going up, given the need of the hour is to boost growth, but it shouldn't come at the cost of inflationary pressures or the current account deficit increasing, again putting pressure on the currency. So it's a bit of a fine balance, but it's by and large on the balance it's more constructive.
When you are really facing that kind of a fine balance, which is kind of difficult to maintain, markets mostly correct. The action is on the negative side. What are you really expecting for next 6 months, given the kind of global and local macro backdrop you just mentioned?
Yeah, I think based on fundamentals, I think global growth has been fairly robust across the board, across developed markets and emerging markets. The only thing worth watching out for is, now that the big political situation or event in China is over, how does China play out its economic policies, particularly in terms of boosting growth, which has really helped commodities run up. Clearly China has driven global growth in some ways, and that'll be something to watch out for from a fundamental perspective, besides the geopolitical risk, which is hard for anybody to analyze. Locally, again, it's going to be the government spending. Hopefully, the sort of stimulus measures, the rate cuts in GST will also get back some sort of boost in terms of consumer spending. But in terms of markets over the next 6 months, it'll always be driven by flows and liquidity in such short periods of time, and flows continue to remain robust, particularly domestically. I think there's no reason to believe that'll go away unless we see a really sharp correction, but then it's a sort of a chicken and egg situation. You need a sharp correction for those flows to go, and you need flows to reverse for a correction to come. And particularly at a time when foreigners who have been selling in the secondary market for the last 10-12 months have finally turned buyers, and given the situation in Japan with Abe getting elected and Draghi following up with a fairly benign statement around QE in Europe, it's unlikely that the Fed will tighten anytime soon, at least tighten more than what the market is expecting. So even global liquidity seems to be fairly benign. So from a short-term perspective, very difficult to see markets taking a nosedive. At worst, you could see consolidating, but otherwise, you should see this upward move continue.
It's heartening to really hear that FIIs are turning positive after several negative months in terms of FII data, so to say. But what stories are they really liking, or what stories are you recommending at this point of time?
I think it's twofold. One is the hope is the same quality names which have been pumped up in terms of valuations. One would hope to see some sort of correction so that they become attractive again. But the other strand is about a portfolio reconstruct, where if we see spending around roads as the government's Bharatmala project has sort of started, you see interest going into areas like EPC and infrastructure in general. But also, if the PSU recap goes through, or rather more than if, it's when the PSU recap goes through, you might see funding being available for certain sectors which have been sort of constrained by lack of funding from the banking system. And those sectors could come into play as soon as those recap happens, and not just coming back into existence, but also can foresee a path of growth for them over the next 2-3 years. So you could see sectors like engineering, industrials, infrastructure, like I mentioned, potentially even real estate, seeing some money flowing into them away from some of the more expensive sectors which have held up over the last 3 years. Particularly, I think private sector banks facing the retail segment and NBFCs could be at a loss here, where valuations are fairly punchy. At the same time, with the PSU bank recap, one could assume that the pace at which that they were gaining market share may not be the same going forward, and hence you need to see some sort of pullback in terms of earnings growth, as well as the earnings multiple as well. So you could see some sort of portfolio reconstruct happening in that way.
In your answer, Pramod, is a belief that PSU banks will start maintaining or regaining or not losing their market share almost immediately.
Yeah, it'll take a while. I think it'll take a quarter or two before we can see that. We should also wait and see for how the government goes about allocating that capital. All we know is, of course, every PSU bank will get enough to plug the hole that the NPA situation will create. By the time we see that, we should also see some sort of development on the insolvency issue, so that we know what sort of haircuts are we talking about. But there is some excess growth capital in that number that the government has come up with, and it depends on who gets that number. Our sense is some of the larger PSU banks will be up there to receive that, so that they can start growing. Now, in terms of their ability to pass it on to the financial system, I think some of the larger guys are clearly in a position to do that. Rather than saying that they'll start regaining market share, the best way to see it is the pace at which they were losing market share perhaps will come down, which is why I'm saying that earnings growth for a private sector bank facing retail or NBFC could take a knock a few percentage points.
I want to mark Rain Industries is down another 5% today. GVK Power is down another 2.5% today. So there's a bit of a correction that is creeping into some of these names which have moved up in the recent past. Watch out for those. And Religare is on a roll. The last 2 days, I think these two names, both Fortis and Religare, have had a bit of a respite. Religare in particular is up another 10% today. I don't know what Fortis is doing today, but should be interesting. Pramod, one question, I'm throwing this out of the dark at you, but this is not based on the coverage that you may have, but more based out of the experience that you may have. The kind of correction that we've seen in the ADAG group stocks, I'm again not asking you to comment on an individual name out here or give me levels or anything, but just the fact that a scare in one principal group company is leading the market to start painting some of the others with the same brush as well. What would your thoughts be? I repeat, this is not a question based out of your coverage area, so I'm not expecting you to give me a informed answer, but just a thought here.
Yeah, but we've seen that in the past as well, right? So when you have to, when you see distress in one asset, it sort of leads to a contagion amongst related assets, because there is all sort of related implications on the group in general, particularly when it comes to balance sheet issues, where you could have cross holdings and stuff. In this situation, I'm not aware of the particulars, but we've always seen that it cannot be contained into one company. But at the same time, it also might give some opportunities where there are other assets which are fundamentally strong, but the market is sort of overreacting, and it could be available at reasonably good prices, provided one can see sustenance or those businesses continuing into the future. So once you make up your mind and you think the asset is strong enough, but it's been underpriced by the market, it could also throw some opportunities. It could work both ways.
Honestly, for a while there was no capital available, or for some other reason no transactions were really happening. But now we are probably in the season of recapitalization, where if PSU banks are getting capital from the government, Axis managed capital from private sector as well. So all these over-leveraged, distressed companies, whether or not in the NPA segment, do you see a lot of deals happening, and there could be upside due to that?
Yes, I mean, particularly in sectors like metals, which have been given a huge relief by Chinese economic policies, which have led to metal prices rallying globally, and that's also helped some of the distressed Indian companies, particularly in the area of iron and steel. We reckon there could be some sort of value emerging there. I mean, it's clearly activity is increased in terms of potential M&A, and that could clearly result in upsides there. As relates to, say, other sectors such as thermal power, one cannot say the same, because we haven't seen the same sort of support coming in. You've had a relatively benign situation as far as power prices are concerned. You still have the state electricity boards, which aren't in a great position in terms of ability to purchase power. At the same time, you have renewables picking up. So while sectors such as metals, in particular steel, could see some upsides in terms of at least away from the distress that they've seen, some other sectors might continue to remain in distress. So you need to be selective in that way.
Interestingly, Bhushan Steel is up 5% today.
Okay, Pramod, on that note, we'll let you go. Thank you so much for taking the time out and joining us. I look forward to, of course, speaking to you more often.